the beginning of a reset. One of these big banks, the Western banks, fails to deliver, creates a daisy chain of defaults and of forfeitures and bankruptcies and counterparty risk and credit default swaps and like bringing in AIG into the moment again, and boom.
It is extraordinary that here we are with gold shooting into new high ground, and the amount of interest in, if you like, the Western alliance amongst the people is virtually zero.
The problem with silver is there's not an alternative to silver in so many of these different uses, whether it be solar, medicinal, technological. Silver's the best conductor there is. So there's not a replacement for it. So if the price of silver goes higher, what do?
In today's news recap, central banks' insatiable appetite for gold is firmly entrenched. Central banks have started the new year exactly as they ended 2024 by increasing their gold reserves. Krishan Gopal, senior analyst for EMEA at the World Gold Council, was active on social media Friday, documenting central banks' gold purchases last month. The day began early when Gopal noted that China once again increased its gold reserves in January, buying 5 tons of the precious metal. Analysts have been particularly focused on China. This marks the 3rd consecutive month that the People's Bank of China has increased its official gold reserves, following a 6-month pause after an 18-month buying spree. Last month's purchase helped lift gold reserves to 2,285 tons, Gopal said. Although China has significantly increased its gold holdings, the yellow metal still accounts for only about 5% of its total foreign reserves. Analysts suggest that there is ample room for China to raise its gold holdings to 10%, bringing it more in line with other developed market central banks. China wasn't the only country buying gold. Gopal noted that data from the National Bank of Poland shows it purchased 3 tons of gold in January. This lifts its total gold reserves to 451 tons, 26% higher than in January 2024 and 97% higher than in January 2023. Gopal said. Poland was the top gold buyer last year, with its national bank increasing reserves by 90 tons. Elsewhere in Europe, Gopal reported that the Czech National Bank also purchased 3 tons of gold in January. Its gold holdings now total 53 tons, 63% higher than at the end of January 2024, he said. Gold now also accounts for over 3% of total international reserves. Finally, Uzbekistan was the biggest gold buyer last month, with its central bank purchasing 8 tons of gold. Sovereign purchases dominated the gold market last year, with central banks collectively buying 1,045 tons of the precious metal, according to the World Gold Council's annual and 4th quarter trends report. Before we show you more clips, smash the subscribe button and check out our huge discount on NordVPN, the fastest and most reliable VPN on the market. This VPN service is a perfect fit for smart stackers who want their privacy protected and don't want their data compromised by prying eyes. For less than the price of a cup of coffee, secure your internet access and get 3 free months with our promo. Believe me, the only problem you'll ever have is that you didn't get it 6 months ago. Let's get back into the episode.
Well, certainly in the over-the-counter derivatives, I mean, it's counterparty to counterparty. When you look at the futures, that's, you've got a central counterparty in the form of COMEX. Is COMEX going to survive this? Well, this is, I think it's a force majeure, maybe in prospect, if this really does deteriorate. And this is where David Webb's book, The Great Taking, comes in, because what happens? I mean, the Great Taking is taking what you think you own in terms of bonds and equities and all the rest of it, registered through a central counterparty, and that central counterparty taking that because they have a prior lien on it, as it were, from the issuers, direct with the issuers, they would take that and use it as collateral, basically, in the event of a market meltdown, credit collapse, whatever, however you like to describe it, okay, they'll still owe it to you. But you may not quite like the idea of, say, your gold ETF being taken from you and deployed for other things without your permission. I mean, the fact is you don't own it. And not only do you not own it, but also the central counterparty doesn't own it. But they've got a piece of paper that says they can use it as collateral. That is basically where we are. And I think this crisis is really beginning to hot up. I do see higher interest rates as a result of the credit bubble deflating. That will take down capital markets big time. And getting back to what you were saying about why people just don't understand the gold is money and all the rest of it. I mean, you look at the mining sector, and the big brokers have spent nothing on researching mines at all. I mean, to them, it's been a dead duck for so long. They've been chasing, cryptos and, NASDAQ stocks and all the rest of it. That's where their research effort really is. Not the research in high tech counts for very much, because that's all momentum stuff rather than value stuff. But you can see that that with nobody really covering the mining stocks, that is why there is so little interest in the mining stocks. That is obviously going to change, and I suspect that with gold going over $2,800, and I think maybe even going over $3,000 in the not too distant future, there's going to be a wake-up call for people who don't have gold, don't have mining stocks, and thinking, what do we, we better, equities are tanking, it's not doing terribly well. My goodness, what do we do with our portfolios? And I think you'll find that investment managers will rebalance, by which I mean they will sell down the momentum stocks, and they will look for value elsewhere. And there's one sector which is absolutely screaming out value, and that's the mining sector. And I think that's where they will go. But they've got to be they've got to be scared into selling, the momentum stocks first. And incidentally, I've run charts in the past comparing Bitcoin with NASDAQ. There's absolutely no doubt at all that it's the same cohort in both markets. And when NASDAQ crashes, I mean, I remember, was it in what they call the Great Financial Crisis, which will be minor compared to the one which is potentially ahead of us. I remember how NASDAQ really plummeted. I mean, I can't remember what it was, top to bottom, but I mean, you look at sort of it's 80% or something like that. I mean, and, if that happens again, and it will happen again, and I think it'll be more than 80%, where's your Bitcoin gone? And again, I think that a lot of people have gone into cryptocurrencies as an alternative to gold, and they're going to get a very, very nasty shock. It's just totally the wrong thing to do. I mean, okay, if they banked some of their crypto gains and moved it into gold, I mean, well done them. But most of them will go to bed with this one. They'll lose a lot, basically.
In today's news recap, Wall Street bereft of gold bears as safe haven sentiment sweeps markets. Main Street also sees higher prices next week. Gold saw another standout week of price action as the impact of ongoing tariff threats combined with rising inflation fears drove investors to the yellow metal. Spot gold kicked off the week trading at $2,797 per ounce. And after a quick spike up to $2,802, prices slid down to what proved to be the weekly low of $2,774 per ounce just before Sunday evening. Tuesday morning saw a similar move, with gold trading around $2,816 before spiking up to a fresh weekly high of $2,843 per ounce by 10 a.m. This time, the yellow metal also made a sustained move higher during the Asian and European sessions. And by Wednesday morning, spot gold was already trading at $2,867 per ounce, with North American traders driving it to a new nominal high of $2,880. But Friday brought renewed drama to precious metals markets with the release of January's non-farm payrolls report, driving spot gold from $2,862 per ounce all the way to a new all-time high of $2,886.85 following the release of the University of Michigan Consumer Sentiment Survey, which showed one-year inflation expectations rising a full percentage point in just 1 month. The latest Kiko News Weekly Gold survey showed industry experts as bullish as they've ever been on the yellow metal, while retail traders also saw further gains in gold's near-term future. Up, said James Stanley, senior market strategist at Forex.com. As of right now, spot gold has just pushed up to a fresh all-time high. While something like that is difficult to chase, I think it's even more difficult to fade it, as there's no signs yet that the run is over. I still like gold prices higher. Neutral, as we are in a cyclical topping area, said Mark Leibovit, publisher of the VR Metals Resource Letter. Up, said Adrian Day, president of Adrian Day Asset Management. Momentum with gold as the drivers of the gold price over the past year remain intact. Soon we will need a pause and consolidation, but perhaps not yet. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
It used to take 2 to 3 days. Now it takes 4 to 8 weeks. And it's not just from the Bank of England vaults. Evidently, it's from all sorts of vaults all throughout the LBMA network. And what it tells you is that they don't have the gold to make deliveries. It's not taking that long to refine them. It means if they have to refine them, they don't have the gold. And that means the gold that they show that they have is not for sale. No one's getting rid of it. And if they don't have the gold, how close are we to some sort of an event where, I think in London, the numbers that if I remember, David Jensen talked about, they trade twice global annual mine supply per day, every day. In silver, it's 3.5 times annual global mine supply per day. And to his numbers, 90+% of all of these trades are paper naked trades. Now, the theory is that everyone's worried about a 10% import tariff on gold. And more so than silver, the argument against silver is that we're in a supply deficit here in the States, so he won't do it because he has to import it. Don't know if that's true or not, but it would make sense. With gold, on the other hand, you have, I don't know, I haven't looked lately. There's a guy on Twitter that does a great job of showing the rehypothecation of gold, but it was always in the neighborhood of 1,500% or higher. I mean, that's just conservative. It's probably much higher than that, but that means that the contracts are sold over and over and over and over and over again. 15 people have the same contract thinking they have their own contract is what that would basically mean. And cash settlement is very, very close at that rate. I was talking to a guy the other day at dinner in my community, and he is involved in aluminum and had a force majeure moment where his manufacturing business needs lots of aluminum, had contracts they couldn't deliver, they cash settled. It's force majeure. That's what we're setting up for here. And these players are saying, man, I got all these contracts. And when you have a contract, if I go short and you go long, well, most people just cash settle. Most people like Miles Franklin two bottles of water here. This is 5,000 ounces of gold in my warehouse, 5,000 on COMEX. I sell here. I own physically here. If the price in my warehouse drops by $100, I'm down $500,000 in gold, but I went up 500,000 on what I sold short. I'm not looking to take delivery. I have it covered. A lot of the people are just speculating the way they do in buying stocks or going to the casino, and others are manipulating the market. And they manipulate it by naked shorting because they got massive, massive checkbooks. And maybe they're even being told by the Western elite, go ahead and do this for us, would you? Thank you. And by doing such, remember, you as the long have the right to say, no. I'll stand for delivery, thank you. And that's what we saw in January. Massive deliveries, right? So what if everyone says, I see you guys are screwed. Delivery, please. Now, isn't that what the Hunt brothers did? Sure is. Hunt brothers saw the same exact things, and the exchange changed the rules on them. Said you can go long just 1 million contracts or so. You can go short as much as you want. Please, thank you. I mean, stupidity. But the point of it is that, yes, that is the rumor. But I would look much past that and say what you see are these claims, these promises of delivery in London. You got a whole big vault full of IOUs and a little bit of gold. And I've been saying forever, and maybe this is it. You know, the little boy who cried wolf, here I am. One of these days, wolf will coming, and maybe this is it. Maybe they all say, we got him cornered, y'all. Let's stand for delivery and watch what happens. And that's what they're doing. They're getting it home preemptively in case there are tariffs because they know they cannot come up with the gold. But lo and behold, having the same problem in London with these delivery delays. So, you know, you can only manipulate a market over a very long period of time by pushing it in the direction that it is going. They are trying to hold back the global demand of powers that are as challenging as us, especially when you combine them all together.
In today's news recap, China to start trial for insurers to invest in gold. China's National Financial Regulatory Administration revealed on Friday the initiation of a trial program aimed at integrating insurance funds into gold investments. As per the organization, this initiative, named the Pilot Program of Insurance Funds Investing in Gold, is designed to broaden the channels for the use of insurance funds, optimize the insurance asset allocation structure, and promote insurance companies to improve their asset liability management level. Additionally, the agency stated that it will diligently monitor the advancement of this pilot, reinforce regulatory oversight, and foster the growth of insurance funds investing in the yellow metal. What do you think of this? Is the master plan being revealed in front of us and no one is paying attention? Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
There is a physical gold market tightening already in place. And I mean, you're seeing that, you're just seeing that on COMEX. You're seeing it because LBMA is having to ship metal. I mean, 400 tons, that's a lot. That's more than what COMEX delivers probably in a year's time. So there's already tightening from the standpoint of, big money. I can tell you the retail demand in the United States has definitely slacked off, and we're now seeing a huge amount of sellers. And I think that's a function of the real economy has been much softer than has been reported. People have eaten into their savings, and they're liquidating gold, they're liquidating silver to survive. I think the real story, when all is said and done, is not going to be gold, but I think it's going to be silver. And I think the March delivery month is already starting to shape up where there could be huge delivery demand and potentially a failure to deliver. And I've said all along, I thought that the fuse would be silver. And once that went off, then gold would immediately go off. So I don't think there's going to be, I do believe that the deliveries will be done for February gold on the COMEX. But I think the real problem is March silver. If you look back, and I mean, you can look, going back to the 1980 episode, just go look back and you'll see that the reality is because silver is such a small market, that sentiment and flows affect silver far greater than gold. And I guess the easiest way to explain that is in a bull market, silver goes up faster than gold. And in a bear market, silver goes down faster than gold. So in my mind, the reality is that once there's a trend that has begun, silver leads, gold does not. To this point, and I mean, obviously we've had a pretty good run. To this point, silver has not kept up with gold in this particular move. But if you look at past moves, I mean, go back to, what was it, 2010, 2011, gold ran up to $1,800, $1,900, but silver ran from, I think it bottomed at $15, $17 and ran to 50. I mean, that was a triple. And then you hit the top and silver bleeds out faster than gold. So I think if you look at past events, just look at just look at the correlation. Silver has more volatility than gold.
What do you think about Bill Holter's insights on the BRICS nations, the silver squeeze, and the potential explosion in gold and silver prices? Are we really on the verge of a massive shift in the global financial system? Let us know your thoughts and predictions in the comments below. Do you see silver and gold skyrocketing soon, or do you think the squeeze might ease up? Let's discuss it. Now, check this video right here because it's a perfect fit for you, and I'll see you on the other side.